Most traders fail not because they can't find good setups, but because good setups make them reckless. That's the paradox that will flip everything you believe about trading success. The cleaner the chart, the dirtier the execution. When your pattern looks perfect, your brain upgrades hope to certainty, turns risk into background noise, and opens the door to oversized positions and rule bending that feels small in the moment, but proves fatal in the math. Meet Sarah, a former quantitative analyst with a PhD in mathematics who can spot market inefficiencies faster than most algorithms. Her charts are masterpieces of technical precision, multiple timeframes, advanced indicators, complex systems that would make hedge fund quants jealous. She stays up until 2 a.m. studying new strategies, convinced the next indicator combination will crack the code. Yet she's blown through 3 trading accounts in 8 months, losing over $40,000. Every winning streak inflates her confidence until risk creeps up, stops get moved, and one bad trade becomes a referendum on her self-worth. Compare her to Jim, her neighbor who works construction. Jim barely understands moving averages. His charts have 2 lines, price and a simple trend indicator he found on YouTube. He trades for 30 minutes each morning before work, risking the same small amount every time with mechanical precision. No emotions, no exceptions, no brilliance required. Jim has been quietly profitable for 2 years straight, steadily compounding his modest account, while Sarah spirals deeper into frustration and debt. This isn't about intelligence or market knowledge. Sarah is objectively smarter by every measure. Yet Jim succeeds where Sarah fails, because there's an invisible psychological wall separating consistent operators from frustrated gamblers. This wall isn't visible on any chart. No indicator can measure it. No strategy can overcome it through clever entries or exotic techniques. Yet it determines everything. The difference between traders who compound wealth steadily over years and those who blow up accounts repeatedly despite superior market knowledge. Here's what makes this wall so dangerous. The smarter you are, the more invisible it becomes. Your intelligence becomes your enemy because it convinces you that better analysis will solve psychological problems. You start believing that if you can just find the perfect setup or the most sophisticated strategy, you'll achieve consistency. But you are trying to solve an emotional problem with an intellectual solution, and the market doesn't care how smart you are. By the end of this journey, you'll have the complete blueprint to dismantle this wall and transform sporadic wins into predictable, sustainable growth. You'll shift from Sarah's frustrated gambler identity to Jim's unconscious operator mindset. We'll build your operator's loop, plan, execute, journal, adjust, with protocols that make emotional interference impossible. You'll learn why the market is a mirror reflecting discipline back with compound interest, why operating like a casino owner beats playing like a casino guest, and why sitting in a sniper's nest beats chasing every market move. The stakes couldn't be higher. Continue believing that better indicators will save you, and you'll join the 95% who fail, facing not just financial ruin, but the psychological devastation of constantly undermining your own success. You'll become trapped in an endless cycle where hope turns to disappointment, always convinced the next strategy will be different. I've tracked this pattern across hundreds of traders over the past decade. There's one critical moment in every losing streak where a single choice determines your entire future. Not about market timing or trade selection, but about recognizing this wall exists and choosing to tear it down rather than climb over it with better analysis. What is this invisible wall, and why does everyone miss it until it's too late? The answer lies in 3 deadly lies that every struggling trader tells themselves. Lies so convincing that even the smartest traders fall for them completely. Which lie are you telling yourself right now? The invisible wall from Chapter 1 isn't built from ignorance. It's constructed from 3 lies so seductive that brilliant traders like Sarah defend them with religious conviction. These aren't innocent mistakes or temporary lapses. They're psychological defense mechanisms that protect your ego while destroying your account, creating what I call the consistency death spiral that traps 95% of traders in endless cycles of hope and disappointment. Lie number 1. I just need a better strategy. Strategy hopping looks like ambition. It's actually avoidance. Every time you abandon a system after a few losses, you're postponing the real work. Learning to execute consistently under pressure. You become a strategy collector, accumulating dozens of approaches but mastering none because you flee at the first sign of variance. Meet Marcus, a software engineer who built a mean reversion system with a 70% win rate, average wins of 1.1 R, and average losses of 1 R. The math was beautiful. Expected value of positive 0.47 R per trade. His backtests glowed green for 2 years of historical data. Then came live trading and 3 consecutive losses in week 1. Instead of trusting his tested edge, Marcus started second-guessing entries, convinced his system needed improvement. He spent the next 6 months hunting for the Holy Grail, never allowing his profitable approach to reach statistical significance. Marcus had mathematical edge but lost money because he couldn't separate normal variance from system failure. Lie number 2. This time is different. This is how profitable systems get murdered by their own creators. Exception making feels intelligent because you're using discretion and market awareness. The setup looks too good to pass up, the news seems clearly bullish, or you just know this trade will work. Marcus fell into this trap after rebuilding confidence with his original system. When a perfect breakout appeared just outside his entry criteria, he made an exception, then another. Soon his rules became suggestions, and his 70% win rate crumbled to break even because exceptions don't follow back-tested probabilities. Lie number 3. I can handle the pressure. Overconfidence in emotional control leads to the biggest account killers. You maintain composure through small losses and moderate wins, building dangerous faith in your willpower. Marcus believed this completely, until his exception-making triggered a losing streak. Revenge trading felt justified because he was due for a winner. He doubled position sizes, widened stops, and chased price action, all while telling himself he was in control. His brain had hijacked his plan, but his ego convinced him he was thinking clearly. Here's how these lies create the consistency death spiral. Strategy. Hopping prevents you from building genuine confidence through repetition. Exception making destroys whatever edge you do develop. Overconfidence in emotional control leads to position sizing disasters when pressure peaks. Each lie feeds the next, creating a self-reinforcing cycle where every attempt to improve actually makes things worse. The gambler's mindset operates by convincing yourself, better strategy will save me. This situation is special. I can handle whatever comes. The operator's approach works by verifying through data. Does my expectancy remain positive? Am I following my rules? What does my journal reveal about my actual behavior under stress? Operators keep scorecards, win rate, average R multiple, and adherence percentage. If adherence drops below 85%, they don't tweak entries. They tighten behavior. The market isn't a casino unless you make it one. When you operate like a casino owner, instead of playing like a casino customer, you understand that edge comes from consistency over time, not brilliance in individual moments. The market becomes your teacher, repeatedly presenting the same lesson in different disguises until you finally learn it. Respect variance, follow rules, keep size manageable. Review honestly. In Chapter 4, we'll formalize this into the operator's loop that makes discipline automatic and exceptions expensive. But there's a fourth lie even more toxic than these three, one that prevents traders from ever breaking free because it attacks the foundation of who you think you are. What happens when your identity becomes inseparable from your trading results? The fourth lie is the most toxic because it masquerades as strength. I am my results. When your identity fuses with your P&L, every winning trade inflates your ego, and every losing trade shatters your self-worth. This isn't just uncomfortable, it's financially catastrophic because your brain starts trading to protect identity instead of executing edge. Meet David, a marketing executive who began trading to build wealth for his family. After 3 consecutive winning days, he felt invincible. He texted friends about his natural talent, researched expensive courses, and mentally drafted his resignation letter. His identity had fused completely with temporary success. The market became his mirror, reflecting back genius-level self-worth with every green candle. Then came 2 normal losses, small drawdowns within his tested system's expected variance. David's emotional state collapsed entirely. He couldn't sleep, snapped at his wife, and spent hours staring at charts, hunting for someone to blame. Within 48 hours, he swung from feeling like Warren Buffett to questioning whether trading was destroying his mental health. This wasn't about the money lost. It was about identity under siege. This emotional whiplash creates identity arbitrage, the dangerous gap between who you think you are and how you actually behave under pressure. David believed he was disciplined and rational, but his behavior revealed someone whose self-worth depended entirely on external validation from market movements. When results turned negative, his true identity emerged, someone willing to abandon every rule to avoid feeling like a failure. Identity-based trading breeds 3 specific account killers that destroy even profitable systems. First, revenge trading becomes inevitable because losses feel personal rather than statistical. David started doubling position sizes after drawdowns, not because his system suggested it, but because his ego demanded vindication. Second, position sizing errors multiply during winning streaks because success feels like proof of superiority rather than normal variance. Success intoxication leads to risk escalation when you should maintain consistency. Third, complete rule abandonment occurs because following a system feels like admitting you're not special, not gifted, not naturally talented at reading markets. Here's the mathematical truth that destroys this lie completely. Expectancy, win per x average win, loss sun x average loss. Expectancy, win x average win, loss and sun x average loss. Study that equation carefully. Notice what's missing. Your feelings, your identity, your ego, your opinion about whether you're smart or stupid, talented or hopeless. The market doesn't care about your self-image. It only responds to consistent behavior over statistically significant sample sizes. Professional traders don't have better strategies. They have better identity management. They understand the core principle that separates operators from gamblers. You are not your results. You are your process. Your worth isn't determined by today's P&L or this month's performance. Your value lies in how consistently you execute your plan, how honestly you review your mistakes, and how systematically you improve over time. This creates your crucial fork in the road. The gambler's identity is outcome-focused and excitement-seeking. Gamblers need drama, volatility, and emotional intensity to feel alive. They measure success by individual win sizes and define themselves by their best trading days. When results disappoint, their entire self-concept crumbles, leading to desperate attempts to restore self-image through bigger risks and abandoned rules. The operator's identity is process-focused and consistency-seeking. Operators find satisfaction in following their plan perfectly, regardless of individual trade outcomes. They measure success by adherence percentage and expectancy over time. When results disappoint, they review their process for improvements while maintaining emotional equilibrium. Because their self-worth isn't tied to market movements. Which path will you choose? The gambler's path offers short-term emotional highs, but guarantees long-term financial and psychological destruction. The operator's path feels boring initially, but compounds into extraordinary wealth through systematic discipline. In Chapter 4, we'll build your transformation framework, the operator's loop that converts this identity shift from concept into automatic behavior. But first, you must make the choice. Will you continue letting the market determine your self-worth? Or will you finally separate who you are from what the charts show you? Choice is made in a moment. Consistency is built in a loop. Coming out of the identity fork from Chapter 3, you don't need more inspiration. You need mechanics that make the right choice inevitable every single day. The operator's loop is your transformation engine. Plan, execute, journal, adjust. This isn't motivational wallpaper. It's the gear system that turns outcome chasers into risk managers through systematic repetition until discipline becomes automatic and boredom replaces drama. The loop works because each phase constrains the next, making emotion irrelevant by making decisions mechanical. You're not relying on willpower or hoping inspiration strikes at market open. You're building a continuous cycle that operates independently of your mood, your recent results, or your opinion about what the market should do next. The market remains your teacher. The loop ensures you actually do the homework, is where identity meets mathematics. This is your risk manager phase, executed before you even open your trading platform. Define your risk per trade, daily loss limit, and exact time windows. Name your A+ setup in one sentence. If you can't write it on a sticky note, you can't execute it under pressure. Build your sniper window, specific weight filters that force perfect alignment before you act. You're not in a casino hoping for luck. You're in a sniper's nest waiting for conditions that maximize probability while minimizing risk. Example filters: price above 20-period moving average, pullback into predefined zone, volatility above threshold, time within your session window. If any condition is missing, you wait. If urgency rises, you wait 2 more candles. Planning isn't predicting. It's narrowing the battlefield to places where your edge is provable through data, not hope. Like a sniper, not a tourist. When your sniper window opens and all criteria align, you act with mechanical precision. No position size adjustments based on confidence levels. No stop modifications, because this setup feels different. No hesitation, no second guessing, no negotiation with your plan. Your job isn't to predict the next tick. Your job is to take the next qualified shot with fixed risk. Then let mathematics play out over statistically significant sample sizes. This single trade outcome is irrelevant to your identity or your process. You're playing a 1,000-hand game where individual results don't matter, like a scientist collecting data for breakthrough discoveries. After every session, record 4 elements: facts, feelings, fidelity, and fixes. Facts: market conditions, setups taken, R multiples achieved. Feelings: your emotional state at entry and exit, calm, urgent, doubtful, overconfident. Fidelity: adherence score from 0 to 100. Did you follow your plan exactly? Fixes: one behavioral adjustment you'll test next session. Keep it short and brutally honest. Over 2 to 4 weeks, your journal becomes X-ray vision for self-sabotage patterns invisible during live trading. Like a mechanic, not an artist. Weekly reviews reveal the smallest changes that address your biggest leaks. If adherence drops below 85%, you don't touch entries. You reinforce behavior through tighter session limits or stronger weight filters. Only when adherence is solid do you test micro-optimizations. Install your variance budget here. Your planned tolerance for losing streaks, so panic doesn't hijack position sizing. Pre-commit: I tolerate 6 consecutive losses at 0.5% risk. Daily loss limit of -2 R triggers session end. Weekly drawdown of -8 R cuts size by half for 10 trades. Decide once, execute many. Here's the pattern: interrupt your nervous system. Resists: Doing nothing is strategic action. Flat is a position. Standing down during low volatility or unclear structure preserves both capital and psychological energy for the next clean window. The loop makes emotion irrelevant by making decisions mechanical, turning the casino into your systematic business. But understanding isn't enough. You need specific protocols that make exceptions impossible. What are the 12 non-negotiable rules that eliminate emotional interference completely? Protocols turn values into behavior and make discipline boring, which is exactly what you want. If Chapter 4 gave you the operator's loop, this chapter bolts it to the floor with 12 non-negotiable rules that eliminate emotional interference completely. Your brain will scream for exceptions. Your protocols make exceptions impossible. This isn't about becoming emotionless. It's about achieving emotional detachment, where consistent emotional states replace the psychological roller coaster that destroys accounts. Meet Jennifer, a nurse practitioner who understood technical analysis perfectly, but couldn't execute consistently. She'd swing from euphoric confidence after big wins to crushing despair after normal losses, giving back all gains through revenge trading and position sizing errors. When she committed to these protocols, her trading transformed from emotional chaos into mechanical precision. Protocol 1. Fixed risk per trade with daily loss limits. Jennifer risked exactly 0.5% of her account balance per trade, never more. Daily loss limit of -2R triggered immediate session shutdown. This single rule cut her risk of ruin in half by preventing revenge trading escalation. No confidence adjustments. No sure thing exceptions. Mathematics doesn't negotiate with emotions. Protocol 2. If, then wait filters for entry conditions. Jennifer wrote her setup in binary language. If price above 20-period moving average and pullback touches 50% retracement and volume exceeds average, then enter long with fixed stop below swing low. Missing any condition equals no trade. Period. Protocol 3. Absolute stop discipline. Stops are set before entry and never moved against position. Ever. Jennifer's stops represented maximum acceptable loss, not suggestions for future negotiation. Move a stop once and you teach your brain rules are optional. Protocol 4. Environment design eliminates distraction warfare. Phone on airplane mode, news feeds blocked, social media closed. Jennifer's trading space became a monastery of focus where only price action and her plan existed. External noise creates internal chaos. Protocol 5. Pre-committed stops and targets before entry. Jennifer calculated risk-reward ratios before clicking buy or sell. If she couldn't identify exits before entering, she was gambling, not trading. Targets and stops became mathematical decisions, not emotional negotiations. Protocol 6. One setup focus for 30 days minimum. Jennifer stopped chasing 17 different approaches and committed to mastering one breakout pattern. Setup hopping is strategy hopping in disguise. Her adherence jumped from 40% to 92% through focused repetition. Protocol 7. Maximum daily trade limits prevent overtrading destruction. 3 trades maximum per session, then done regardless of results. Overtrading isn't ambition. It's addiction disguised as opportunity. Scarcity forces selectivity. Protocol 8. Break-even days count as wins. Jennifer redefined success. Protecting capital became profit. Days following her plan perfectly, but finishing flat demonstrated professional behavior. Flat is a position. Preservation is progress. Protocol 9. Mandatory trade. Journaling with emotion tracking. Jennifer recorded emotional states at entry and exit. Calm, urgent, doubtful, overconfident. Pattern recognition emerged after 20 trades, revealing personal sabotage triggers invisible during live execution. Protocol 10. Recovery protocols after losing days. After any -2-hour day, Jennifer's next session began with half position size for 3 trades. Ego demanded revenge. Protocols required rehabilitation. She prescripted recovery instead of improvising disaster. Protocol 11. Weekly expectancy reviews using the 3-number scorecard that predicts your future. Win rate, average risk-reward ratio, and protocol adherence percentage. Jennifer focused on how well did I follow my plan, not how much did I make. Only when adherence exceeded 85% for 4 consecutive weeks did she consider strategy adjustments. Protocol 12. Risk increase only after proven adherence. Account growth doesn't automatically mean position size growth. Jennifer's risk per trade stayed at 0.5% until she demonstrated 6 months of consistent rule following. Discipline first, leverage later. These protocols created Jennifer's transformation from emotional trader to mechanical operator. She went from losing 40% of her account in 8 months to achieving positive expectancy over her next 100 trades. Her emotions still existed, but they couldn't hijack her decisions anymore. Your 3-number scorecard, win rate, average risk reward, and protocol adherence predicts your future better than any indicator. But how do these rules perform when the market launches real psychological warfare with news spikes, grinding chop, and cold streaks that test every protocol you've built? Protocols sound bulletproof on paper until the market launches full psychological warfare designed to make you abandon every rule you've built. Your 12 protocols from Chapter 5 aren't suggestions for calm markets. They're armor for the 4 battlefield scenarios that separate operators from gamblers. Every trader faces these tests repeatedly, and the market doesn't care about your good intentions or theoretical knowledge. The only question that matters: will you follow your plan or your feelings when chaos erupts? At 8:30 a.m., consumer price index data hits and SPY gaps up 2% in 30 seconds, then whipsaws violently back down. Gambler Mike sees the initial spike, and his brain screams opportunity, while FOMO floods his nervous system. He chases the momentum at the peak, gets slipped on entry, moves his stop twice to give it room, and finishes -4R as the gap fills completely. His fatal error: trading within 3 minutes of major news releases, violating the most basic environmental protocol. Operator Jennifer watches the same chaos from her sniper's nest. Her Protocol 4 environment design means no news feeds are screaming at her, and her no trades first 3 minutes post-news rule keeps her hands locked off the keyboard while amateurs get slaughtered. She waits for structure to reappear, then looks for her A+ setup in the aftermath when spreads normalize and real price discovery begins. No FOMO, no chase, no regret. Her protocol saved her from joining the 90% casualty rate that news events create. The market teacher wore its siren costume, and she passed the test by doing nothing. The market opens flat and stays flat. No clear direction, no momentum, just endless back-and-forth action that triggers false signals every 15 minutes. Mike takes 9 trades, scratching on 8 and losing on 1, his frustration building with each failed attempt. By trade 10, he doubles position size, desperate to salvage the session, and finishes -3R, tilted and exhausted. Death by 1,000 paper cuts, exactly what chop days are designed to create. Jennifer's chop filter triggers automatic stand-down mode when average true range drops below her threshold. Her if-then-wait filters from Protocol 2 recognize that grinding days destroy accounts through overtrading, not missed opportunities. She closes her platform after identifying low volatility conditions and spends the morning reviewing past trades instead. Flat becomes her position. Preservation becomes her profit. The market wore its fog costume, testing patience over action, and she understood that sometimes doing nothing generates the highest ROI by preserving both capital and psychology. After days of consolidation, the market picks a direction and begins sustained momentum. Mike fights it because it can't keep going up, taking 3 countertrend trades that get stopped out as momentum continues. His opinion overrides his system, and he's fighting the teacher instead of learning the lesson. When he finally capitulates and chases the move, he enters at the worst possible moment, just before a normal pullback. Jennifer sees the same trend, but waits for her first pullback-only rule to trigger. When price retraces into her predetermined zone with aligned moving averages, she enters long with mechanical precision. No opinion about whether the trend should continue, just execution of her tested protocol. She captures plus 3R as momentum resumes, then stops trading per her maximum daily limit from Protocol 7. The market rewarded her patience with compound interest while punishing Mike's impatience with compound losses. 5 consecutive losses within normal system variance push Mike's ego to demand vindication. He doubles position size on trade 6, convinced he's due for a winner. When that trade also loses, he triples size on trade 7, abandoning his variance budget completely. His account hemorrhages as statistical noise becomes financial catastrophe. Jennifer faces identical losses, but her recovery protocols from Protocol 10 kick in automatically. She reduces position size by half for the next 10 trades, treating the streak as mathematical variance rather than personal failure. Her pre-committed variance budget: I tolerate 6 consecutive losses at 0.5% risk, then reduce size until adherence recovers. Prevents small drawdowns from becoming account killers. She understands losing streaks test discipline, not intelligence, and her protocols make panic impossible by making decisions mechanical. Each scenario ends with the same crucial question: did you follow your plan or your feelings? The market presents identical lessons wearing different masks: news whipsaws, chop sessions, trend days, drawdowns. Your protocols are your armor against psychological warfare that never stops. The teacher market isn't punishing you. It's testing whether you've learned that discipline plus patience plus resilience beats prediction every single time. Notice how the operator's decisions felt boring and small in the moment, but proved massive and liberating in the mathematics. That's the quiet compounding of professional behavior. Each protocol violation avoided builds compound interest in both capital and confidence. Your 3-number scorecard keeps you honest: win rate, average risk reward, and protocol adherence. Only the 3rd number is completely under your control, and it's the only one that ultimately matters. But here's the uncomfortable truth that even perfect protocols can't solve. Rules turn into suggestions when the person running them is secretly chasing identity hits instead of executing edge. When adrenaline rises and ego whispers that you're special. When the market offers its most seductive opportunities, something deeper than protocols must hold the line. How do you make the operator identity stick when every fiber of your being wants to return to the gambler's excitement? Perfect protocols crumble when operated by imperfect identities. Chapter 6. Proved your rules survive market warfare. But here's the keystone truth that changes everything. You don't rise to your goals. You fall to your protocols, and your protocols fall to your identity. If you secretly still see yourself as a gunslinger who outsmarts markets, your rules will quietly become suggestions when adrenaline peaks and ego whispers that this situation is special. Time to retire the romantic mythology completely. The trader as maverick identity is a direct pipeline to the consistency death spiral. Embrace the unsexy, yet profoundly powerful truth: I am a risk manager who happens to trade. This isn't semantic wordplay. It's surgical identity reconstruction. Gunslingers seek thrills and measure worth through dramatic victories. Risk managers seek consistency and measure worth through capital preservation over time. The market rewards boring risk management with compound interest, while punishing exciting gunslinging with compound losses. Your transformation begins with the operator's oath, spoken aloud every morning before market open. I protect capital. I execute my plan. I review without judgment. I scale only when earned. These aren't motivational platitudes. They're identity anchors that remind your nervous system what you actually do for a living. Protection comes first because survival precedes opportunity. Execution means taking only sniper window shots. Review without judgment prevents shame from morphing into sabotage. Scaling only when earned stops success intoxication from hijacking size. Identity transformation requires ritualized reinforcement because your brain defaults to excitement-seeking patterns developed over years of financial drama. Morning preparation becomes identity anchoring. Review your plan, visualize perfect execution, remind yourself that flat days demonstrate professional behavior. Write your single objective in one line. Follow the plan at 90% adherence or better. Pre-trade breathing becomes emotional centering. 3 deep breaths before every entry, asking, am I executing edge or chasing emotion? This creates a micropause that severs the impulsive link between feeling and action. Post-trade journaling becomes learning mindset. Record not just what happened, but who you were being when it happened, calm operator or anxious gambler. The market will test your new identity through the sabotage trinity that destroys even profitable traders. FOMO whispers that you're lazy for following weight filters when obvious opportunities appear. Your identity response becomes automatic. I am a risk manager. My job is capital preservation, not opportunity maximization. Missing profitable trades I didn't take is infinitely preferable to losing money on trades I shouldn't have taken. Install the identity rule. If I feel urgency, I wait 2 candles and recheck my filters. Overconfidence emerges after winning streaks, convincing you that recent results prove superior market reading ability. Your identity response: I am a risk manager. My wins came from following my system during favorable variance, not from being smarter than the market. Identity rule: if I'm up plus 2R for the day, I consider stopping to lock in professional behavior. Revenge trading erupts after normal drawdowns, demanding immediate vindication through increased position sizes. Your identity response: I am a risk manager. Losses are business expenses, not personal attacks. My job is protecting remaining capital, not recovering past losses through escalated risk. Identity rule: if I lose minus 2R, I reduce size for the next session and write the lesson by hand. Design your environment to reinforce who you are. Clean desk, single monitor during execution, phone in another room. Checklist taped at eye level. Oath, risk, setup, stop, target. This is your sniper's nest, not a casino floor. Before every click, ask, am I here to manage risk or to feel something? If you're chasing sensation, stand down. The market mirror metaphor reaches full power here. It reflects your discipline back with compound interest and your impulsiveness back with compound losses. Every protocol followed builds both capital and identity strength. Every exception made weakens both your account and your sense of professional self. The reflection is mathematically precise. Discipline compounds geometrically, while chaos compounds catastrophically. Here's your identity litmus test. After 3 losses, do you automatically reduce size and protect the loop? Or do you escalate to protect your ego? After 3 wins, do you tighten rules to avoid intoxication? Or do you loosen them to chase hero status? Your answers predict your equity curve better than any technical analysis. This identity shift prepares you for the ultimate paradox that most traders never discover. Strategic boredom creates extraordinary wealth by harnessing the most powerful mathematical force in finance. But how does methodical, almost painfully dull execution become the fastest path to life-changing money. This is where everything clicks into place. Your operator's loop, 12 protocols, and risk manager identity merge into a single consistency engine powered by compound boredom. Not the soul-crushing boredom of indecision, but the strategic boredom of executing the same high-quality behaviors every day until your equity curve resembles a well-run business instead of a gambling addiction. The paradox becomes your competitive advantage. The less drama you allow into your process, the more drama your compounding creates in your net worth over time. Here's the resolution to our 3-number equation mystery from Chapter 5. Win rate, average R multiple, and protocol adherence above 85% create equity curve stability even before your win rate improves. Here's the mathematical proof. A system with 45% wins at 1.8 R average and 55% losses at 1 R average yields expectancy of plus 0.26 R mod per trade using this formula. Expectancy 0.45 1.8 R, 0.55 1 R, 0, 81 R ma, or 26 R. Expectancy 0.45 V 1.8 R, 50 1 R, 0, 81 R, na V 26 R. But expectancy means nothing without adherence. With 90% protocol adherence, your realized expectancy approximates 0.3 R because mistakes don't leak much value. With 60% adherence, FOMO entries, stop violations, and position sizing errors crush that edge to 0 or negative. Adherence acts as a multiplier on everything else. Raise it, and stability appears even before your technical skills improve. Strategic inaction is action. Flat is a position. Your sniper window isn't a waiting room, it's your edge. Protecting downside through fixed risk, stops you never widen, and daily loss limits creates the runway for upside to compound naturally without your interference or opinion. The market reflects discipline back as smooth equity curves and reflects impulse back as jagged peaks that always end in cliffs. This creates the boredom flywheel that accelerates wealth through systematic dullness. Boring execution preserves capital. Preserved capital maintains clear thinking. Clear thinking produces better decisions. Better decisions create slight expectancy edge. Expectancy edge generates more boring profitable days, and boring profitable days compound exponentially over time. Each rotation makes the next rotation easier and more powerful, building both financial and psychological momentum. Watch the mathematics with Alex versus Emma. Alex commits to 3% monthly returns through boring consistency, single setup focus, fixed 0.5% risk per trade, hard stops on daily losses. After 12 months, his mathematical result under year 1, growth ajak 1 dolman, 312, 14258, shortu my 1.8% annual return. Year 1 to growth midend 1.03, 12 around 0.4258, 42.58% annual return. Starting with $10,000, Alex reaches 14,250 date through relentless mediocrity. Extend this to 5 years. 5-year growth 103,605 to 1892, 489.2% total return. 5-year growth 1.03, 60, 508.92, 489.2% total return. Alex's boring discipline turns $10,000 into $50,920 over 5 years without a single hero trade. Emma chases excitement with 50% monthly volatility, massive wins followed by devastating losses. Her arithmetic average might look impressive, but geometric reality stagnates because inconsistency taxes compounding. A minus 50% month requires plus 100% just to break even. After 5 years of dramatic swings, Emma typically remains near her starting balance, exhausted and demoralized, while Alex quietly builds generational wealth through compound boredom. The mathematical law governing this transformation? Wealth des consistency time. Wealth des consistency time? Consistency raised to the power of time creates exponential results that dwarf any spectacular individual trade. Emma's volatility resets her compounding every few months, while Alex's precision lets mathematics work uninterrupted. The market rewards patience with compound interest and punishes impatience with compound losses. Strategic boredom operates through 3 mechanisms that gamblers never discover. First, emotional detachment prevents the position sizing errors and rule violations that destroy accounts during both winning and losing streaks. When trading becomes routine rather than dramatic, your brain stops hijacking your plan with ego-driven decisions. Second, consistent small edges compound geometrically, while inconsistent large swings compound arithmetically at best. Third, boring execution creates psychological sustainability. You can maintain disciplined mediocrity for decades, but heroic willpower burns out in weeks. Your mantras crystallize into operational philosophy that replaces gambler thinking permanently. Discipline plus patience plus resilience becomes your holy trinity, replacing excitement plus opinion plus urgency. Plan it, trade it, log it, learn it becomes your daily rhythm, replacing the chaos of impulse, react, regret, repeat. These aren't motivational slogans. They're behavioral instructions that your identity executes automatically when protocols become second nature. The consistency engine generates wealth through systematic mediocrity that most traders reject because it feels too simple and too slow. Your edge isn't predicting market direction. Your edge is executing the same boring process repeatedly while others chase excitement and blow up accounts. You become the casino owner, collecting small edges consistently while everyone else plays customer, hoping for jackpots. Here's the paradox that completes your transformation. The fastest path to extraordinary wealth runs through extraordinarily ordinary execution. While others seek the perfect trade, you execute imperfect trades perfectly. While others hunt for market secrets, you master the only secret that matters, doing simple things consistently over long periods without getting bored and abandoning the process. Your consistency engine is built and calibrated. The operator's loop provides the framework, your 12 protocols provide the guardrails, your identity shift provides the fuel, and compound boredom provides the acceleration. But knowing isn't doing, and building isn't operating. You need a specific implementation container that transforms this knowledge into permanent behavioral change. The market will keep teaching the same lessons in different costumes: news whipsaws, chop sessions, trend days, drawdowns. The question that determines your financial future: will you finally do the homework? Your 30-day transformation protocol begins now, and it will determine whether you join the 5% who succeed or remain trapped with the 95% who understand everything but execute nothing consistently. Knowledge without implementation is expensive entertainment. Your operator's loop, 12 protocols, identity shift, and consistency engine become worthless without a transformation container that converts understanding into automatic behavior. The 30-day operator challenge isn't another trading course. It's behavioral surgery that replaces gambler reflexes with operator discipline through systematic practice until professional choices become inevitable under pressure. Your protocol is deliberately constrained to force mastery over complexity. One setup only for 30 days. No exceptions, no additions, no obvious opportunities outside your chosen pattern. If you can't describe your setup in one sentence using if-then language, you're not ready to trade it consistently. Choose something simple. Break out above resistance with volume, pull back to moving average in uptrend, or reversal at key support. Complexity destroys consistency, and consistency is the only edge that compounds. Risk becomes mathematical, not emotional. Fixed 0.5% to 1% risk per trade based on account size. Never adjusted for confidence or sure things. Daily loss limit of -2R triggers immediate session shutdown with zero negotiation. Maximum 3 trades per day prevents overtrading addiction. Mandatory chop filters using average true range. If volatility falls below your threshold, you stand down regardless of boredom or FOMO. These ain't suggestions. They're circuit breakers protecting you from psychological hijacking. Day 0 preparation builds your operational foundation. Write your setup on one sticky note in binary language. Print the operator's oath and tape it at eye level. I protect capital. I execute my plan. I review without judgment. I scale only when earned. Define your variance budget. Consecutive losses you'll tolerate before size reduction and exact re-ramping rules. Decide once. Execute many. Daily cadence creates transformation through repetition. Pre-market. Read the oath. Check chop filters. Mark your sniper window. Write single-sentence intention. During execution, follow the 3-beat rhythm. Plan it. Trade it. Log it. If urgency spikes, wait 2 candles. Post-session. 5-minute journal covering 4 elements: facts, market conditions, our result. Feelings: calm, urgent, overconfident, fidelity. Adherence score 0 to 100. Fixes: 1. Behavioral adjustment for tomorrow. Keep entries under 200 words. Progress loves brevity. Enforcement makes exceptions expensive. Any protocol violation equals immediate session end, plus written lesson explaining what happened and prevention strategy. 2 violations, weekly trigger, reset day. Simulation only with adherence scoring. 3 clean days requalify for live trading. After -8R rolling drawdown, cut risk by half for 10 trades. Make rule-breaking painful and rule-following rewarding through systematic reinforcement. Weekly reviews focus on behavior, not profits. Calculate your 3-number scorecard. Win rate, average R multiple, protocol adherence. The mathematical foundation remains elegant. Expectancy, 0.45 8R, 0.551R. Remember below? 26R expectancy, 0.451.8R, 0.551R, plus 0, 26R. Even modest positive expectancy compounds dramatically with consistency. At 90% adherence, you realize most of that edge. At 60% adherence, violations leak edge to 0. Don't tweak entries. Fix behavior through tighter weight filters or reduced trade counts. Small account? Perfect. Your training process without size pressure. Trade micro contracts or fractional shares. Your real asset is habit equity built through repetition. Busy schedule? Choose 1 session or alert window daily. Consistency requires constraint. Scarcity sharpens selection. Success metric revolutionizes progress measurement. Track adherence percentage, not profit and loss. Share adherence scores with accountability partners, not profits. Anchoring identity to process instead outcomes. 90% adherence with break-even results demonstrates more skill than 50% adherence with lucky profits because adherence is completely under your control. Community accountability accelerates transformation. Post your protocols and daily adherence scores in comments below. Subscribe for follow-up content on variance budgets and advanced drawdown management. Teaching others reinforces your learning while connecting you with process-focused traders. All loops close with perfect symmetry. The invisible wall from Chapter 1 was identity, the gap between who you thought you were and how you behaved under pressure. The solution was systematic transformation through protocols making discipline automatic and exceptions impossible. The choice remains binary: gambler or operator, excitement or wealth, chaos or consistency. The teacher market presents its final exam with mathematical precision and endless patience. 30 days from now, you'll have either installed behavioral infrastructure for lifelong success or proven you prefer familiar struggle over unfamiliar discipline. Your transformation begins with your next trade. The market is ready? Are you finally prepared to graduate?